Hey traders, this is Blake Morrow with Traders Summit, and with me today I have Eric Basmajain from EPB Research. Good to see you again, Eric.
Thanks for having me on again, Blake.
You know, it's great having you here, and I want to say a lot's happened between the last time you were here or you and I were together.
Yeah, it's only been, I think, a couple of weeks, but it feels like it's been longer than that because there's been a lot of developments for sure.
There have been, and I really wanted to start off with, first of all, I want to talk a little bit about the Fed. Obviously, the Fed is kind of front and center, or was front and center, and I wanted to see if that changes your view and outlook on anything, because now we have a pretty concrete idea of what the Fed is up to and when they're going to conclude tapering. So, how does that change your views about the U.S. economy with the developments with the Fed the last week?
Yeah, so leading into this, we had an ongoing slowdown in the global and U.S. economy. And prior to the Fed meeting, consensus expectations were pretty dovish that the Fed was maybe going to announce some sort of tapering program, but they were kind of going to leave the dots unchanged. What was interesting was we had the Fed meeting, and they did not announce a tapering program officially, as most people thought that they might, but they were much more aggressive with their dot plot. So what ended up happening, I think the biggest impact from the Fed meeting is that if you look at the median dots that the Fed puts out, they tell you, this is not a forecast, but why do they do it if not to give the market guidance? And what we saw was the median dot plot for the Fed increased for 2022, it increased for 2023, and then the new dot for 2024 was really high. And what that means, or what that signal to the market was that we are going to try and raise rates. The signal was at the end of 2022 that they would start. The market was not pricing that in prior to the Fed. They are pricing that in now. And the way that we see that is the short-term rates have increased. We see 2-year and 5-year rates at 6 and 12-month highs, whereas longer-term rates are not at 6 and 12-month highs. So the short-term rates fully believe the market's new guidance that we are going to get a slightly more aggressive rate hike path than previously anticipated. So the market prices that in through the short-term rates. But what also has to happen is if the expectation of the Fed funds rate goes up, that has to price through all the longer-term rates as well. And that comes through as a higher real interest rate. So we saw long-term real interest rates move up pretty quickly. That caused, a big outflow out of tech and a big rotation into cyclicals. But in my view, the market is misinterpreting that as a positive growth signal. All it is a tighter Fed policy path that increased the real rates. It wasn't a better expectation of growth. So what we still have now is the Fed tightening policy. They're putting in a more aggressive policy path into slowing economic growth. And that's why the market, in my view, is not just localized to tech, is starting to have significantly increased volatility. Whenever the Fed tightens policy into a slowdown, you're going to expect market volatility to increase significantly. And some of the areas that we see the slowdown, some of the things that we talked about a little bit last time is all of the cyclical components of the economy that reflated us out of the expansion are now the segments of the economy that are showing the most protracted weakness.
So that's since we last talked, you were mentioning about the durable goods orders, and we got those numbers yesterday. The headline number was a beat, but the core number was a pretty significant miss. So what are your continued thoughts there?
Yeah, so that's an interesting report. One nuance that I think some people overlook is that a lot of these economic data series, sometimes they don't always tell you. Some of them are reported in nominal dollars. Some of them are reported in real dollars. The durable goods report is reported in nominal dollars. But if we have producer price inflation that's running at 7 or 8%, if these durable goods numbers come in at positive, 4, 5, and 6% annualized, that's actually negative growth in real terms. So in real terms, the durable goods numbers was quite a disappointment, and that was reflected in the Atlanta Fed GDP Now estimate. The Atlanta Fed estimate revised on that new data point, and it was revised lower. Growth came down from 3.6 to 3.2 on the Atlanta Fed estimate. And what's even more interesting about that Atlanta Fed number is that growth has come down from the beginning of August till now. The estimate has dropped from 6.2 to 3.2%. It's
Wow.
dropped pretty significantly.
Yeah.
But of that 3.2% growth, 3.1%, based on the Atlanta Fed's numbers, is coming from inventory building. So 100% of Q3 growth is inventory. And if we look at the cyclical components of the economy, that would be residential investment or housing. That's negative in the Atlanta Fed's model in Q3. Equipment, which would be like the capital goods orders from the durable goods report, negative in Q3. Trade, negative in Q3. And durable goods consumption, things like vehicles, negative in Q3. So if we look at a metric that's called real final sales, which kind of takes out government spending and takes out the fluctuations in inventory, we have negative growth in Q3 in real terms. And the Fed is very worried about inflation, but the inflation problems are exclusively a supply side driven phenomenon. So the Fed is going to try and tighten policy to combat a supply driven inflation problem when all of their policy tools are geared around changing demand. The Fed can raise rates. That's not going to help a ship come in from the port. All the Fed's going to do is tighten rates into a supply-driven inflation story, and that's going to cause real incomes to fall faster because the Fed's going to be stunting demand into a situation where demand's already being stunted from high inflation. So the Fed is gearing up to make a big policy mistake here. It's sort of a difficult situation because there are legitimate supply problems. We see oil prices rising as a result.
Right.
And there's not really much the Fed can do because if it's a supply issue, the Fed has no tools to combat supply problems. They could only rein in demand through tighter policy, but demand's not the problem. As I just noted, housing, durable goods, equipment, and trade are all negative in Q3. So demand is certainly not what's causing the inflation. And the Fed's going to reinforce weaker demand into this inflation picture.
Holy cow. So, you know what, if you're Fed Chairman Powell, you got to be saying, well, my time's about up. You're up. I'm out.
Yeah. That's right. And you know, it is a difficult situation for them because they talk to their business contacts and all they're hearing from their business contacts are we can't get supplies and we can't get labor. Right. So the Fed is getting very worried about this, but these are issues that they can't control in terms of the supply chain issues.
It will be interesting. I think the outlier would be, and I'm just kind of thinking on my comments is that would be something that the market would not be expecting. It would be Powell to be replaced. I don't think the market's really anticipating that at the moment. Let's shift gears a little bit. And we got a few minutes left, but I want to talk a little bit about China. You know, off camera, you and I, last time we spoke, you and I talked about personally kind of some of these policy potential errors that the Fed might make into a China slowdown. And then ironically, maybe a few days after you and I had that discussion, the Evergrande situation kind of bubbled to the surface. And I guess my question to you is, it's got to be on your radar now, but is Evergrande a one-off, or is this more of a symptom of a bigger problem that China has? Is it a deflationary situation? How do you feel about Evergrande in a nutshell and what's happening?
But you said it perfectly. It's a symptom of a larger problem. So if we go back, I'll try and break this down as succinctly as I can. If we go back from 2010, you know, as I talked about in some of our earlier interviews, we had very weak growth on average from 2010 to 2020. But there were these cyclical ups and downs that happened along the way. There was a big upturn from 2010 to 12. Then we had a downturn. Then we had an upturn from 2016 to 18. And then we had a downturn. Those upturns and downturns were almost exclusively driven by China credit creation and most specifically property development. So that infrastructure spending out of China was so massive that it basically caused a reflation of the commodity cycle 2 different times. And then after COVID, they did it again. The problem is that they have a very Ponzi-like model to the way that they do this property development. It's all bad debt. And some of that is starting to come to the surface. Now, China's tried to rein in this credit growth 3 different times. All 3 different times caused a major disinflationary wave across the global economy. And then they sort of went right back to it and reflated it again. Now the problems are becoming a little bit more intense. I'm not a China expert in the sense that I could tell you whether this is going to be contagion or this is going to be a Lehman event or anything like that. What I can tell you, though, and the implications for the global economy is that if China does use this as a opening to sustainably reduce their credit growth or sustainably calm down the rampant property development, that's going to have a major disinflationary impact on the global economy through the commodity channel. And one of the things that we can look at here is the divergence between oil and copper. Oil is rising rapidly. Over the last 6 months, I think I just made a chart about this. Over the last 6 months, I think oil is up almost about 30%.
Yeah.
But copper's only up about 2%. And copper's been down since April. So copper is very much following the China story, the global growth story lower. Yeah. Oil's got this supply narrative to it. Point being, this Evergrande issue is causing a lot of problems with the China property development market. They're probably going to be reluctant to add even more development or bad debt on top of that. So what we're going to see, in my opinion, is them probably try and have as controlled of a deleveraging or as gradual of a reining in of this property development as they can. And that's likely to manifest itself through weaker commodity prices globally. But that's not a month story or a next quarter story. That's sort of the next several quarters, couple of years. If I have one more second, what I would say, just to sort of hammer this point home, is that over the last 10 years, the US had weak growth. Japan had about 4 or 5 recessions in the last 10 years. Europe had 1 or 2 recessions in the last 10 years. And all of that came with China growing at 6, 7, 8%. They were reflating the entire world economy, and most of the developed markets couldn't get out of their own way still because of such bad debt and demographic problems themselves. The question investors should be asking themselves is, if China is going to rein in this property development and 6% China growth is no longer a reality, we're going to downshift those expectations to something like 2 to 3%. What does the world economy look like with a 2% China? If Japan couldn't really get out of a recession with China growing at 6 to 8%, Japan may never grow again. I mean, if China is really going to grow at 1, 2, 3% going forward.
You think it's they'll move in lockstep then? Potentially, that would be the risk.
That's right.
Wow.
Yeah.
Oh, wow. All right. Well, Eric, that's some. I'm gonna go suck my thumb in the corner. So I'll be right back. No, but really some very insightful conversations here, and I think a lot for us to chew on. The one thing that the takeaway that I have right at this moment in time is, we have, the Fed that might be making a policy error in a time when the global economy could significantly be slowing down. So that's a lot, like I said, a lot to chew on today.
Yeah, that's right. And some of my longer term work is focused on, larger government sector or larger government expenditures having negative effects on long-term growth. Those effects are usually second, third, and fourth order effects, sort of the unseen. And what we're sort of witnessing now is a lot of the things that policymakers tried to do to alleviate the burden of the COVID recession are creating a lot of the problems that we're seeing now.
Wow. Okay. Well, Eric, I'm going to be super excited to have you on. Hopefully in the next few weeks, we can circle back and see where we're at. And hopefully my thumb I'll still not be sucking my thumb.
Well, hopefully we can have a more rosy outlook.
Yeah, let's hope so. Hey, Eric, how do I find out more about what you do if I'm listening to this right now?
Yeah, epbmacroresearch.com. You can find everything. There's a contact tab, and I'm also super active on Twitter at @EPBResearch. And I also post some stuff on Traders Summit also.
Great. And it's great to have you here. I know our traders do appreciate it and appreciate having you here. So have a great day. Thank you so much for joining us today.
Thanks so much, Blake.